Meg Green with AM Best TV. The global non-life reinsurance sector represents $250 billion worth of gross written premiums. Joining us now to discuss the sector from AM Best, we have Scott Mangan, Associate Director, Bob DeRose, Senior Director, and Steve Chirico, Director. Gentlemen, thank you for speaking with us today.
Thank you.
So we could start with Bob. What is the outlook? What is AM Best's outlook for the global non-life reinsurance industry?
Well, Meg, we're actually revising the outlook after several years of being negative to stable. And the primary reason for that, the overriding reason for that really is that market conditions still remain very, very competitive. But we really feel that going forward, the rate of deterioration should be nil. We think that the providers of traditional and non-traditional capacity realize that market pricing and conditions really are at the bottom, and there really isn't much room for further deterioration. If investors and reinsurers are to earn returns that are really commensurate with the risk that they're taking. It was a rather difficult decision for us to come to, given the fact that market conditions are not what they once were, but we don't really perceive them ever returning to those glory days either. So we've decided to move the outlook to stable based on those high-level circumstances.
So how did you decide the outlook?
Well, Meg, last half of 2017 and the first half of 2018 was a period of affirmations. And what was affirmed to us are how the market would respond to significant catastrophic activity that we hadn't seen in quite a long time before that. And encapsulated in that is the behavior of alternative capital, the persistency on one side and the appetite for return expectations going forward on the other side after significant losses have been sustained by some alternative capital providers. Additionally, with the increased movement in interest rates and the expectation that asset returns will follow was also something that's occurred that has not occurred in a very long time. Bob DeRose has said many times in public speaking engagements that the low interest rate environment, and we say that, low interest rate environment on a risk-adjusted basis in particular, is the biggest catastrophe that's ever hit the reinsurance market. Also, we are returning to U.S. economic growth that we hadn't seen in quite a while. That's another significant factor. And then the last affirmation is enterprise risk management. So with the lack of significant catastrophic activity, one could come up with a thought experiment that reinsurers would relax enterprise risk management, how they view accumulations of risks, in the race to remain relevant from a premium perspective. So it was affirmed that all companies that we rate and are involved with came handily through the catastrophic period with only earnings results. So no company had to raise capital from either a solvency or a rating perspective. And while the return on equity basically went to zero for the industry, about a 110 combined ratio, it was clear to us that after that catastrophic activity, that the industry stuck to their knitting and kept their ERM platforms alive and running.
Yeah. Yeah, so I absolutely agree with all of those points, and I think that clearly the new dimension to the market, certainly over the past 5 years, has been third-party capital. The investors in that type of capacity do have lower return hurdles than traditional capacity. But what we've seen transpire, and Steve was alluding to this, is that there's been a closer alignment between third-party and traditional. We've certainly seen the traditional reinsurers utilize that type of capacity more so to take the extreme tail losses out of the equation, which lends itself to more stable underwriting performance, even in catastrophe-exposed years. So the 110 combined ratio, when you stop and think about it, given the magnitude of events that occurred in 2017, certainly was very, very reasonable and well within expectation. That said, these losses have gone to the third-party capital providers after a period of benign, a long period of benign catastrophe activity. They're starting to feel some of the pain or some of the volatility potential in this particular segment, and we think that they're going to expect to hold pricing going forward, that there really isn't any further potential for deterioration going forward. And we really think that that is the primary factor that really leads us to come to a stable view of what pricing conditions are going to be going forward.
And alternative capital viewed as maybe a foe in the respect that it was adding pricing pressure to rates. Also maybe as a friend on some level as well, and it took some of the volatility off those rated balance sheets.
Definitely did.
So, Scott, we're seeing a lot of consolidation in the industry. What impact is that having?
Well, it's certainly allowing companies that are becoming larger to provide more products, more reinsurance solutions to cedents, which is definitely positive. In some cases, it's a little bit of a negative in terms of cedents wanting a more diversified panel. There are fewer and fewer reinsurers to provide that diversification, so there is a little bit of a concentration risk there. But it also, from an efficiency perspective, it improves efficiencies. They have greater synergies, more back office capabilities, and things in terms of claims and accounting and those sorts of business activities should become more efficient and cost effective.
Yeah, I think that market conditions that have existed over the past several years are really what is causing or contributing to the need for more M&A activity. We've seen a lot of it. We expect that that will continue, as market conditions will probably continue to remain somewhat challenged. What I do think is interesting is when you look at the actual transactions that have occurred, it's been traditional reinsurer acquiring traditional reinsurer in order to gain size and relevance. But what's really even more interesting is the fact that some non-traditional capacity has been acquired by traditional capacity.
And the other way around.
And the other way around. So it's really aligning all of the capacity to face the market, and we think that that's another factor that will play into a stabilization of market conditions going forward. Of course, we can't say that with absolute assurance. It is somewhat of a guess, but it would be our expectation that with capacity in the hands of fewer should lend more to more market stability than when capacity is in the hands of many.
And as maybe a cautionary comment, we do have to be careful that M&A can be viewed as a veil of an ailing franchise. So certainly the day-to-day ratings meetings that we have with companies that are considering merger and acquisition activity, that's a question that's usually number one on our list.
Yeah, and I think that you can even, when you look at the players that have come together, those that have been acquired probably either didn't have the market depth, breadth, or performance that really were going to allow themselves to sustain themselves over the longer term.
As a standalone.
As a standalone company.
The universe of reinsurance companies is a relatively small body, correct? So consolidation, that won't give primary writers less choice?
Definitely, and we see that the top 10 in our global reinsurance top 50 controls about 70% of the market. And so there's already a concentration in reinsurance panels, and going forward with M&A activity, that would likely continue.
Yeah, but I think that's important. That's the consolidation is going to be not in the top 10, but in the
From smaller companies.
up to the top 10. So.
And looking at it from the perspective, it is a very competitive marketplace. So we're starting in a very competitive marketplace. The Herfindahl Index on the reinsurance market labels it very competitive. So with merger and acquisition activity and following the merger and acquisition activity all along the value chain, starting with agents and brokers and primary companies, now reinsurers going through merger and acquisition activity, it's just kind of the logical step, the tail of the dog now experiencing what the rest of the dog has felt over the last decade or so. And that when you have this concentration, one can come to the conclusion that it's becoming a less competitive marketplace. But it's important to remember that it started as a very competitive marketplace.
Is there a minimum size necessary to be a successful reinsurance company?
I mean, I don't think necessarily. I think smaller reinsurers can remain relevant to clients. They have to work a little bit harder at it. They may not be able to provide the same array of products, but what they can do is provide service and value add on top of it. But at the end of the day, the bigger companies will be able to provide a little bit more product range and in some cases greater services too there. So it's a difficult proposition for smaller reinsurers.
I think it's a market where relevance is certainly very important. However, there are regions of the world where local market knowledge and presence are very, very important. Culture, I guess, is the way to describe that. And in those parts of the world, Asia, the Middle East, smaller reinsurers can survive and thrive. Generally, they are pass-throughs. They provide the mechanism for the larger reinsurers to access the market through retrocession. So we don't like putting size requirements on any company. I think that there are some smaller reinsurers that have done quite well and are currently in the market and thriving because they have a particular niche that they serve, and they serve very, very well.
I'd also piggyback on that and say the definition of what a small insurer is reinsurer is changing over time. So 2 or 3 years ago, a $3 or $4 billion balance sheet was sufficient to be a medium to larger size reinsurer. As time has gone on and there is increased M&A activity, that bar for what would be classified as a large reinsurer has been rising ever since.
So how is ILS impacting the market, and could you say what percentage it is today?
I think it's about roughly 20% of the industry now. And the immediate impact that you're seeing is on the property catastrophe segment, where it's a lot easier in terms of the complexity of claims for ILS to participate. But what you're seeing that is, to some degree, pushing the traditional players out of that space and into more casualty lines. And so where you had an overcapacity in property catastrophe lines, now you're seeing some of that slowly shift into the more traditional casualty lines.
I mean, when you stop and think about the global reinsurance segment, the U.S. is the largest reinsurance market in the world. And a large portion of that market was property cat. And indeed, that's where the greatest margin or the greatest profit potential had existed historically. It's also the easiest for the ILS market to penetrate because of the sophisticated level of modeling that exists and the relatively short-term nature of the tail. That portion of the market is where the greatest impact has been felt. It's taken a lot of the margin out, to Scott's point, and it has forced traditional players to focus on other classes of business where the ILS currently may not feel as comfortable, but ultimately over time we think that they will try to broaden their scope and get into those classes of business as well. They still have to have some assurance, though, and it may take quite some time before they actually get there. However, the reinsurers themselves can act as a utilizer of third-party capacity, to take some of the tail exposure off, even these longer tail classes of business. And the amalgamation or the coming together of those traditional, non-traditional capital is certainly something that we have an eye on and are trying to really figure out, what will the impact of that be over the longer term. And I think that in the end, it probably, the reinsurers have always been innovative. They've always, have been able to survive and thrive no matter what the circumstances. I think that they are availing themselves to those opportunities that are on the horizon in terms of utilization of third-party capital, not only for property cat, but for other classes of business as well.
A lot of very smart people working on it, and it's just a matter of time before they come up with the right structure, whether it's commutations after a certain amount of period of time, bringing the risk back to the rated balance sheets and taking it away and letting the third-party capital providers collect returns at that point. But again, I think it's just a matter of time.
And I think, Scott, that's a very relevant point in that third-party capital providers, the diversification that they're looking for starts to bleed away if they're tying their money up for a significantly long period of time with the same reserve base. So I think casualty, which has been dampened, right, from an ILS appetite perspective, can be relevant with the understanding that the loss will cease the developing and will return back to its source or some other source, and then the investor then is free to move on to other projects. I think that was the significant appetite for property catastrophe reinsurance. It's more volatile, so you had a willing seller. You had a willing buyer because you had literally 18-month concatenated periods with which you knew for certainty your returns. And you were able to then allow the diversification movement of your investment portfolio for these alternative capital providers along the efficient frontier, not having to worry about a 4 or 6 year tail to deal with.
So going back to your stable outlook, what factors could change that going forward?
Well, I think it's very fundamental. It's, right now we believe that pricing has reached the bottom. I mentioned that market conditions are still very, very competitive. I think that if the market avails itself to irrational behavior going forward and allows for further deterioration in pricing, which ultimately would translate into an erosion of returns, that would obviously cause us to change our outlook back to negative. Now, we are in a rising interest rate environment, and that certainly bodes well for the bottom line over the longer term. Short term, you're going to see somewhat of a mark-to-market, in terms of the assets, but we understand that. But ultimately, you have to generate underwriting profit in order to be a viable organization over the long term, and that's something we keep a very close eye on. So if we were to see, pricing erosion, which results in a deterioration of underwriting earnings, that would certainly be the motivation for us to return to a negative outlook.
Additionally, kind of contemplating the exogenous event of increasing interest rate environment, there's, bifurcating that between asset returns, which I think we can make the argument that on a risk-adjusted basis, they're below where they need to be. And if that just returns, but loss cost inflation does not outpace that, that's a significant benefit to the industry. If, however, loss cost inflation outpaces risk-adjusted returns increases on the asset side of the balance sheet, now we're left in a situation where a significant amount of the net income of the industry can disappear because of that reserve base that's approximately $500 billion will start to dry up from a return perspective. The accretive returns of redundant loss reserve takedowns from prior years, not only will that cease, but you have development from an inflation perspective on that very large base of reserves.
So some reinsurers have invested heavily in InsurTech with the idea that will strengthen the bonds with their clients, the primary insurers. How is that working out for the industry?
I think that there's varying degrees of success. I think that reinsurers recognize that the smaller insurers probably don't have the financial resources or capabilities to really develop sophisticated distribution tools, apps, to really compete with some of the larger players. So I think that, obviously the smaller reinsurers can be the lifeblood for a reinsurer. And reinsurers want to make sure that that part of the market, has some stability to it, that they're not competed against to the extent that they're basically put out of business. So reinsurers have made the investment in InsurTech organizations to develop distribution capabilities, platforms that they can avail to their clients in order to allow them to compete effectively in a very changing technological market. There's definitely technological impacts to the overall market. And I think that we've seen a number of these things rolled out, and they've been rolled out quite successfully. Not every reinsurer is on the forefront. They don't feel they necessarily have to be.
Well, and innovation in reinsurance takes a little bit of a different form than what we would see in insurance.
Right.
It's less touching. There's less interaction with the client. The client is far more sophisticated. We often joke amongst ourselves that you're not going to see an app for facultative coverage on an oil rig where somebody can just dial that up like
That's
that.
right.
It's not where we see necessarily InsurTech playing a role in reinsurance on a larger scale. It's more of data analytics, being able to crunch that data, being able to glean a little bit more and get a competitive advantage in terms of underwriting and understanding the risk a little bit more.
But that's why when you use the word InsurTech, I tend to think of it from a primary perspective rather than from a reinsurance perspective. But reinsurers are making investments in InsurTech firms because they realize that not every producer, not every agent or broker out there has the capabilities, and the insurance company that backs them may not have the capabilities to develop these technological advances that the Progressives and the Geicos and the other primary insurers really have at their avail and can afford to invest in. So they're providing those platforms to the distribution network in order to allow their reinsured clients to survive, to remain competitive in a very changing market environment.
And of course, Bob, if we expand our definition beyond InsurTech to innovation, the reinsurance market has been very innovative. There was a lesson learned, of course, in 1992 after Hurricane Andrew, where things like sophisticated risk modeling and ways of aggregating risk and evaluating risk are very sophisticated and have been for quite some time. We saw a reaffirmation of that in the last half of 2017. But we shouldn't overlook that. So for innovation and InsurTech can be different layers of the same item. And from an innovative perspective, the reinsurance market has survived and thrived based in part on their ability to not just run a modeling agency's models and aggregate them and average them. That's a weak ERM, right? As opposed to forming your own view of risk with inputs from those modeling agencies, but your own inputs, both experiential and purchased, where you're forming your own view of risk, you're underwriting according to that, and that has resulted in the operating performance of our better reinsurers.
And innovation goes beyond pure technology. I think utilization and alignment with alternative capital is a form of innovation that exists today.
New products.
New products, cyber, mortgage.
Mortgage reinsurance.
Mortgage reinsurance. There are many, many innovative aspects that are going on in the reinsurance sector, maybe in response to the competitive market environment. Probably so. We talked about the competitive nature of the market. Different sources of competition is really facilitating or forcing organizations to try to be more innovative across a very, very wide spectrum of opportunities.
And one of those areas is primary insurance. A number of reinsurers are entering the primary arena. Does that create a channel conflict with their clients?
If you speak to some of the few remaining pure reinsurers, they would say absolutely there are channel conflicts. I think in today's reinsurance sector, you can see across the board the vast majority of companies do have primary operations in one way or another, some smaller than others, but again, you can probably count on your hands the number of pure reinsurers that are out there. So there are channel conflicts in items where you would think that it would be most important to keep things close to the vest, whether it's a new product or you're introducing some sort of new coverage where you wouldn't want to expose that to a competitor. But at the end of the day, I think that companies have become comfortable with that. And if you look on the panels of companies' reinsurance panels, inevitably there's going to be a good deal of companies that are writing primary insurance on those panels as well.
And an opposing view could be that the primary verticals of composite companies are kind of a ballast of relevancy, and as premiums were down, not just from a rate perspective, but from an appetite perspective from ceding companies not buying as much reinsurance, it increased a company's relevancy. However, a primary platform alongside a reinsurance platform are managed very differently. They have very different cost structures and return structures. So you can make the argument that they're relatively unwieldy to manage and relatively inefficient from a capital perspective. So kind of distilling all that in, if you would have looked at it on a historical basis, what we were told initially was that it will lend some stability to returns. The last year has not really borne that out, however, and primary platforms of reinsurers have actually been more volatile than the reinsurance verticals.
You could probably go back even further than that to see some of the what we would expect to be earnings diversification not really playing out on the primary side across the board. Some do it better than others, and there are different companies that have different specialties, but I don't think it has been proven to be the ballast that it was expected to be.
And from an underwriting perspective with commercial lines, basically at underwriting unity at about 100 combined ratio, that could be your expectation. Mm-hmm. However, if it's casualty-based business, you get the float for 4 or 6 or more years. That will accrete to the operating ratio, not necessarily the combined ratio or underwriting income.
Which was adversely impacted by interest rates over that time. So, it's mixed bag for sure.
I think that at a very high level, business models are going to and need to evolve over time depending on circumstances as circumstances dictate. I think the birth of the primary reinsurance, the dual platform model, really started to emerge more prominently following the events of 9/11. With most of them were born in Bermuda, and again, the rationale for that is that you want to have the ability to deploy capital through both mechanisms depending on market conditions. When the reinsurance market is hard and there's opportunities, you can deploy your capacity to reinsurance opportunities. And when cession rates come down and trading conditions become more difficult on the reinsurance side, you can utilize your insurance platform to continue to access risk and maintain a reasonable level of top line. I think that that's all true today. I think what's the new part of the equation is alternative capital. I mean, we're seeing reinsurers have a primary business operation, a traditional reinsurance operation, and now an alternative capital vehicle. And I don't know what it will look like in the next 10 years. There may be a whole other aspect to the reinsurance business model. But again, it's the model adapting to the circumstances to remain competitive, to remain viable, to remain profitable, to continue to attract investors, and to continue to have relevance with your insurance and reinsurance and third-party investors, your clients, over the longer term.
Clearly, there's an evolution that occurs here. We see that on a micro perspective, perhaps in the assumption of mortgage risk by reinsurers and the introduction of both hedge fund reinsurers or total return reinsurers, as well as alternative investments in more traditional asset portfolios, increasing in percentage of assets and certainly inuring to those returns. Those are also responding to the environment, a low interest rate environment, as well as the ability to access profitable premium.
So how do you see the market evolving in the next few years when it comes to the issues like primary insurance and third-party capital?
Well, I think that, as Steve mentioned, it's going to continue to evolve. I think that all of those are very, very important pillars to a viable, relevant organization going forward. That doesn't mean that you can't be specialty focused and survive in your specialty niche. As long as you can differentiate within that niche, you can be somewhat more of a purebred and still do well. But I think that overall, we're seeing business models that want to have the depth and breadth of product, of distribution, of capacity, both traditional and non-traditional, to work with in order to be able to take advantage of whatever opportunity presents itself going forward. And I don't see that changing. I think, if anything, organizations are going to try to broaden their capabilities rather than become more narrowly focused.
One of the more recent interesting ideas is the privatization of flood insurance and the reinsurance market then providing capital toward what had been basically a government program in the past. So there are things on the horizon, and there are things that we or the companies haven't even thought of yet that may introduce risk and return opportunities for these companies.
You're going to either have to evolve or you're going to become a dinosaur and not survive. So I really think that organizations are going to have to take advantage of whatever opportunities present themselves, and they need to be dynamic in that thinking.
Great. Well, Scott, Bob, and Steve, thank you so much for speaking with us today. To see a copy of the full market briefing, visit ambest.com, and we'd love to hear from you with any questions. You can reach out to us at webinars@ambest.com. For AM Best TV, I'm Meg Green.